Most people spend 40 years working jobs they tolerate, buying things they don't need, and quietly hoping retirement will save them. It won't. Not unless they play a completely different game, the long game. Financial independence isn't about being rich, it's about being free from debt, free from financial panic, and free from depending on a paycheck just to survive another month. The people who achieve it don't stumble into it. They build it, brick by brick, decision by decision, over years that most people write off as too early to start. This is not about shortcuts. This is about strategy, discipline, and playing a game that rewards patience over everything else. The foundation, what financial independence actually means. Financial independence means reaching a point where passive income, money earned without trading time for it, covers all of life's expenses. That's it. It doesn't require a seven-figure salary or a lucky investment. It requires a shift in how someone thinks about money, time, and value. The FIRE movement, financial independence, retire early, brought this idea into mainstream culture. At its core, it promotes one simple principle: save aggressively, invest wisely, and reduce the number of years spent working out of necessity rather than choice. Some people target retiring in their 30s. Others simply want to reach their 50s without financial anxiety. Both goals are valid. What matters is intentionality. Take the story of someone like Jay-Z.
We had it pretty good in America, and we were flow.
He made a deliberate choice early on to own his masters, launch his own businesses, and invest in assets. He didn't just earn money. He engineered multiple income streams that worked whether he was in the studio or not. That is the mindset financial independence demands. The math behind it is surprisingly accessible. Experts in personal finance have long pointed to a concept known as the 25x rule. The idea that a person needs roughly 25 times their annual expenses saved and invested to live off that portfolio indefinitely. If someone spends $30,000 a year, they need approximately $750,000 invested. If they spend $50,000, they need $1.25 million. The number isn't as unreachable as it sounds when someone starts early and invests consistently. It is the engine that drives this entire machine. Albert Einstein reportedly,
he said, "Put your hand on a hot stove for a minute, it seems like an hour."
Doesn't just grow, it multiplies. A 25-year-old who invests $300 per month in a diversified index fund at an average annual return of 8% will have over $1 million by 65. The same person who waits until 35 will accumulate roughly half that amount. The cost of waiting 10 years isn't 10 years. It's everything those delayed years would have compounded into. The strategy: building wealth with consistency over chaos. Financial independence is won in the ordinary moments, not the extraordinary ones. It is built in the decision to cook at home instead of ordering out 4 nights a week. It lives in the choice to drive a reliable used car instead of financing a luxury vehicle that bleeds money monthly. It grows inside an automated investment contribution made every single payday, whether the market is up or down. The first strategic pillar is the savings rate. This single metric matters more than income level. A person earning $100,000 who saves 10% will never reach financial independence. A person earning $50,000 who saves 40% likely will. Warren Buffett, one of the most studied investors in history, lived in the same modest Omaha house he bought in 1958 for $31,000, even as his net worth soared into the billions. His discipline with lifestyle spending allowed him to funnel capital into investments that compounded over decades. The principle isn't about suffering. It's about prioritizing future freedom over present comfort. The second pillar is investing in assets, not liabilities. A liability takes money out of a pocket. An asset puts money in. A car loan is a liability. An index fund is an asset. Rental property that generates income is an asset. A luxury watch bought on credit is a liability, meaning she didn't just get paid to promote products. She owned the thing generating the money. That ownership philosophy is the same one everyday people can apply through stock market investing, real estate, or building side income streams that eventually run independently. The third pillar is eliminating high-interest debt at speed. Credit card debt carrying 18 to 25% interest is mathematically catastrophic. Every dollar sitting in that debt is a dollar losing more ground than almost any investment can recover. Getting out of debt isn't just emotionally liberating, it is one of the highest return financial moves available. Many people pursuing financial independence follow a structured method: list all debts from smallest to largest, eliminate the smallest one first, then roll that payment toward the next. The psychological wins of clearing debts maintain momentum through what can otherwise be a long and discouraging process. The fourth pillar is income growth. Frugality alone has a ceiling. There is only so much that can be cut. At some point, the math improves fastest by earning more through salary negotiation, career advancement, freelancing, or building a side business. Oprah Winfrey didn't reach financial independence through budgeting alone. She built a media empire, negotiated ownership stakes, invested in real estate, and created content that generated royalties long after she produced it. Her trajectory proves that income ceiling breaking combined with disciplined investing is the most powerful combination available. The mindset. Why most people never finish what they start. Here is where most independence collapse. Not in the strategy, in the psychology. Human beings are wired for instant gratification. The brain rewards spending in the present far more than it rewards saving for a future self that feels abstract and distant. Studies in behavioral economics consistently show that people dramatically undervalue their future needs versus their present wants. This is why lottery winners often end up broke within a few years. The money arrives before the mindset does. The people who actually reach financial independence share one quality above all others: they play defense against lifestyle inflation. This is the tendency to increase spending every time income increases. A raise comes in, and suddenly there is a newer car, a bigger apartment, more subscriptions, fancier restaurants. The financial gap between earning and spending never actually grows, so wealth never actually builds. Lifestyle inflation is the silent killer of financial independence. Kevin Durant, the NBA superstar, has spoken about how his mother raised him to treat money carefully even as his career earnings soared. He has invested heavily in tech startups, real estate, and business ventures, building a portfolio designed to outlast his playing career by decades. The discipline to not spend everything one earns, even when the temptation is enormous, is the defining characteristic of those who eventually cross the finish line. There is also the matter of community and environment. Research consistently shows that financial habits are deeply social. People tend to spend at the level of those around them. Surrounding oneself with peers who value financial growth, discuss investing openly, and normalize frugality creates an invisible accountability structure that makes disciplined choices feel natural rather than punishing. The final and perhaps most important mindset shift is understanding that financial independence is not a destination to arrive at, it is a practice to sustain. The habits that build wealth are the same habits that protect it: monitoring spending, rebalancing investments, continuing to grow income, staying out of debt. These are not temporary behaviors to endure until some magic number is reached. They are a permanent operating system for a financially free life. The long game of financial independence isn't glamorous. It won't trend on social media. It won't generate applause or go viral. But every single day that someone chooses delayed gratification over instant comfort, invests before spending, and stays the course through market dips and life interruptions, they are quietly moving towards something most people only dream about: a life where money is a tool, not a chain. The game is long, the rewards are permanent, and the best time to start playing it was yesterday. The second best time is right now.